Here we are in part 3 of my mini-series. In case you missed part 1, we went through 10 top growth stocks for 2025. In part 2, we looked at 10 top dividend stocks for 2025. And now in part 3, we're going to be taking a look at 5 top ETFs for 2025. Regardless of whether you're a growth investor or a dividend investor, ETFs should be the backbone of your portfolio. Where the differences come in is how much weighting you're going to have for those. For me, roughly 30 to 40% ETF weighting within my portfolio. And it should already be well known that an S&P 500 ETF, some exposure to some extent, should be towards the top of your portfolio. So one of these 5 ETFs, I'm not going to be wasting your time with discussing the S&P 500. So before we unveil these 5 ETFs, show your appreciation for the research that we do on a regular basis, putting out these free videos by simply clicking that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their top 10 stocks to buy right now. All right, let's jump back into the video, taking a look at 5 top ETFs for 2025. Beginning with ETF number 1, which is going to be the Schwab US Large Cap Growth ETF, stock ticker SCHG. Let's begin with what I like to call the granddaddy of growth. You've heard me say it before, you want to have diversification within your portfolio, but there is such thing as over diversification. Even the likes of Warren Buffett has talked about this. Often I'll see people post about having S&P 500 funds and then having something like VTI, which is a total US market ETF. To me, for my portfolio, that's over diversification. I want higher exposure rate to the best companies, the highest conviction companies, which are going to be at the top of the S&P 500. So for me, between those two, I'm going to go with VOO. But that focus takes another step when we're talking about SCHG. The ETF currently has $37 billion in assets under management, and the focal point here is large cap growth stocks. Over the past 12 months, SCHG is up nearly 40%. With interest rates seemingly staying in this higher for longer period heading into 2025, this could set up really well for these big cap growth companies yet again. Looking here, you could see the sector breakdown for the ETF. At the top, to no surprise, is technology, amounting to 48% exposure, followed by consumer discretionary at 14% exposure. Then communication services at 12.5%, healthcare at 10%, and rounding out the top 5 is the financial sector with a 7% exposure rate. These percentage rates need to be focused on as an investor, especially when you're managing your own portfolio. Because if you have a portfolio that's already overexposed to the technology sector, an ETF like SCHG is only going to further push that overexposure rate. All of that needs to be kept in mind. But now let's take a look at the largest holdings, which include the likes of Apple, Microsoft, Nvidia, Amazon, Tesla, Broadcom, Meta Platforms, Google, and Eli Lilly. The top 10 account for 56% of the portfolio, and in total, the fund has 229 positions. So again, a lot of the same positions you see at the top of the S&P 500, except the exposure rates are that much higher. So if you're looking for exposure to these big mega cap tech companies, SCHG is a great way to go. In terms of expense fees, the fund has a very low expense fee at just 0.04%, making it a great low-cost fund. And that leads us to ETF number 2, which is going to be the Schwab US Dividend Equity ETF, stock ticker SCHD. Going from the granddaddy of growth to the granddaddy of dividends, SCHD checks off all the boxes. Whether you're focused on high yield, it has higher yield than most high yield dividend ETFs. If you're focused on dividend growth, it has faster dividend growth than most dividend growth focused ETFs. And on top of all of that, it is a great complement to tech-heavy portfolios. SCHD currently has assets under management of $64 billion, and again, the focus is large value dividend payers. Over the past 12 months, SCHD is up nearly 10%, and that is including after the big sell-off we just saw. Now that we've had that big sell-off, we are looking at SCHD, which is trading around those August 5th levels. So if you missed it then, you're getting another opportunity. And as investors, especially long-term investors, you are constantly looking for those opportunities to get back in. And the intrigue over a long period of time is that interest rates are inevitably going to start coming down. Now, they may not be coming down as fast as we hoped, so we have to be a little bit more patient. Looking here, you could see the sector breakdown. And at the top, you won't find technology. In fact, you won't find it in the top 5, as the top sectors are financials with 20% exposure, healthcare 15%, consumer staples at 14%, energy at 12%, and industrials at 11%. Technology only accounts for 10%, with communication services only accounting for less than 5%. That right there is why I talk about SCHD being a great complement. If you're looking to diversify a little bit more, and maybe you're already heavy into technology, heavy into communication services, SCHD is a great complement. The top 10 holdings include Cisco Systems, BlackRock, Bristol-Myers Squibb, The Home Depot, Chevron, Verizon, Pfizer, Altria Group, Texas Instruments, and UPS. The top 10 holdings account for a little over 40%, and there's 103 total holdings within SCHD. The portfolio is rebalanced every quarter, and it goes through a full reconstitution every single March. So coming up here in a few months, we could get some brand new additions to SCHD. The fund is also, again, a very low-cost fund, having an expense ratio of just 0.06%. And that leads us to ETF number 3, which is the iShares Small Cap ETF, stock ticker IJR. There's a lot of intrigue when it comes to small caps. There's also some risks that comes along with small caps. But I'm upbeat on the sector because we have a Trump 2.0 administration coming back in. What is he looking to do? Bring down regulations, spur the business, spur the economy, which could bode well for small cap businesses. In terms of assets under management, IJR has $87 billion. And of course, the focus is on small caps. Over the past 12 months, the fund is up nearly 10%, and that is included after the big sell-off we saw here in December. In times of strong economies, we typically see small caps do well. However, they haven't outperformed the greater market in nearly a decade now. So that trade is overdue. Less regulation is beneficial to small caps, and hopefully down the road, lower rates is all going to be a benefit. Tailwinds for the small cap sector as a whole. But although the tailwinds are there, volatility is undeniable when it comes to small caps. So know that going in. Here we can have a look at the top sectors where you could see the likes of financials, industrials, consumer discretionary, technology, and healthcare making up the top 5. When it comes to small caps, there's literally thousands of companies out there. Many that don't even make a profit. Many that aren't that well run, which is why it goes back to what I was talking about with over-diversification. When you look at the popular small cap fund IWM, they're investing in over 2,000 small caps. I want to be more focused on the largest, the best, the highest quality small cap companies out there, ones that are gaining momentum towards becoming a mid cap. That's exactly what IJR does. It focuses on 600 of the largest small cap companies. Being that they are small caps, you may not recognize some of the top holdings here, but here's a few of the more popular names, which include Bath & Body Works, Comerica Bank, Glaukos, Alaska Air, Robert Half, and VF Corp. In total, the ETF has 612 holdings, with the top 10 making up just 7%. So it's constantly changing at the top based on the underlying stock movements. The expense ratio is again very low at just 0.06%, making for a great low-cost option. And that leads us to ETF number 4, which is the iShares Cybersecurity and Technology ETF, stock ticker IHACK. Cybersecurity continues to be a major theme for me heading into 2025. I actually believe that cybersecurity as a sector could be even larger than that of AI. There are a number of different cybersecurity ETFs that are on the market today, but IHACK is one that I'm focusing on heavily here heading into the new year. The ETF currently has assets under management of just $915 million. The focus is obviously on cybersecurity, and over the past 12 months, the fund is up roughly 10%. The need and demand for cybersecurity comes without question. Any business that's operating without it should just turn in their notice today, because the threats continue to pile up. They continue to get even more sophisticated, regardless of the size of the company. There's a number of great cybersecurity type companies out there, but without having to choose one or two winners within the space, why not focus and lean more into an ETF like IHACK? The sector breakdown here is pretty simple because all cybersecurities for the most part are technology stocks. There is a small 3% of companies within the fund that call themselves industrials. The top 10 positions include Fortinet, SentinelOne, which is a name I like a lot, Acton Technology, Palo Alto, CyberArk, Trend Micro, Checkpoint, Varonis, Zscaler, another name I like individually, and Acme. Number 11, which you can't see on this list, happens to be CrowdStrike, which is the most recognizable cybersecurity name on the market today. In total, the fund has 46 positions, so it's very focused, with nearly 50% of the fund being made up of the top 10 holdings. The expense ratio is the highest on today's list, but among the lowest of all cybersecurity ETFs at just 0.47%. And that leads us to ETF number 5, which is going to be the Select Sector Spider Utility ETF, stock ticker XLU. When it comes to looking back at the Trump administration 1.0, utilities actually performed quite well, up north of 30%. But I'm taking a different angle because a lot has changed in the past 4 years. And the angle I'm taking is with AI. When you talk about AI, or we talk about supercomputers or data centers needed to support these, they all have one thing in common. They need power. And that's where XLU comes in, and all of those utility companies. The ETF currently has $16 billion in assets under management, and as you can imagine, the focus is strictly on utility companies. Over the past 12 months, XLU is up 23%. Now, there's a number of ways to play this AI craze that we're going through. There's the chip designers, there's the chip makers with the foundry companies, the equipment makers, the data center landlords, or the utility players. And on top of that, these companies tend to pay juicy yields from time to time. The sector breakdown is the most simple, as the fund only invests in utility companies. The top 10 holdings include NextEra, which is a favorite of mine, Southern Company, Duke Energy, Constellation, Sempra, American Electric Power, Vistra, Dominion, PG&E, Public Services Enterprise, rounding out the top 10. And these top 10 holdings account for more than 55%, with a total of 34 holdings. So very focused from this ETF here. So not only do I like utilities in general, I really like NextEra. It's a company that pays a great dividend with strong dividend growth, and it's at the top of this list with a strong weighting of roughly 12%. XLU is also another ETF. You're seeing a common theme here. I'm on the look always for low-cost ETFs, as XLU currently has an expense fee of just 0.09%, again making it a low-cost option. So there we just looked at 5 ETFs. Some of them are very different from one another. You had utilities all the way up to technology and cybersecurity. Down in the comments section below, let me know which of these ETFs do you like best? Are you most upbeat in heading into 2025? And if you haven't done so yet, make sure you smash that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.